Welcome back to the Deep Dive. It's Monday, February 2nd, 2026, and you are with Talk Tickers. Today, we're cracking open the books on a bank that usually flies completely under the radar, but it just dropped an earnings report that is, honestly, a little bit wild. We were talking about First Business Financial Services, ticker FBIZ.
It's good to be back. And You're right, wild is the word, but in this very understated Midwestern banker kind of way.
Yeah.
We're looking at a quarter that's basically a tug of war. On one side, you have these record-breaking performance metrics that, most banks would queue for.
Right.
And then on the other side, you have one very specific, very large headache sitting in a field in Wisconsin.
It really feels like a tale of two reports. You have the pristine financial statements, and then you have this literal pile of dirt that's causing all the drama.
Exactly. If you just skim the headlines, you see a massive dividend hike, huge earnings growth, and you think, wow, flawless execution. But if you're doing the deep dive, which is, our job, you have to squint at the fine print because there's a credit situation here that it muddies the waters enough to make this fascinating.
So that's the mission today. We have to figure out if that mud is just a splash on the windshield or if the engine is actually leaking oil.
Good way to put it.
We're going to strip this down. We'll start with the headline numbers, the scoreboard. Then we'll spend some serious time on that pile of dirt because it dominated the Q&A.
Oh, it did.
Then we'll look at the growth engines, the macro outlook, and we'll wrap up with our "this is not financial advice" trade idea.
Sounds like a plan. Let's start with the beat. Because purely from a shareholder return perspective, 2025 was a banner year for FBIZ.
It really was. Let's look at the earnings. For the full year 2025, their earnings per share, their EPS, grew by 14% over 2024.
And context is everything here. They have a very specific internal goal, right?
Yeah, that's their line in the sand.
It is. Their long-term goal is 10% annual growth. That's the number they obsess over. The CEO, Corey Chambas, he pointed out that their 20-year average since the IPO is exactly 10%.
Wow.
So to hit 14% in this environment, that is a significant outperformance.
And they're not just hoarding that cash. They announced a 17% increase to the quarterly cash dividend. That feels aggressive.
It is aggressive. A 17% hike is a massive signal of confidence. You have to remember, bank boards are conservative. They hate cutting dividends.
It's the worst thing they can do.
The worst. So you don't raise it by nearly 20% unless you are very, very sure that cash flow is sustainable.
Plus, the tangible book value per share is up 14%. So if you're a long-term holder, you are popping champagne this morning.
You are. But, and there's always a but, if you're an analyst looking at the core engine, you're pausing at one specific number, the net interest margin. The NIM.
The NIM, the lifeblood of a bank. It's the spread between what they pay for money and what they earn lending it out. And it came in at 3.53% for Q4, down 15 basis points.
And 15 basis points might sound tiny, but in banking, that's a lot. A drop that big in one quarter, it sets off alarm bells.
It suggests the core engine is losing efficiency, right? Like deposit costs are spiraling or something.
Usually. But in this case, management is claiming it is not the engine. It's that specific pile of dirt we mentioned. They blamed a non-accrual interest reversal.
Okay, let's unpack that jargon. Non-accrual interest reversal.
It's actually pretty simple. So a bank usually books interest income before they get the cash, assuming the borrower is good for it.
Right, accrual accounting.
Exactly. But if a borrower suddenly stops paying, the loan goes non-accrual and the bank has to go back and erase that income they thought they were getting.
So it's basically an accounting, oops, they have to unbook the revenue.
That's it. And that reversal hits your margin immediately. And this entire thing was because of one single credit relationship.
This is the elephant in the room. This thing dominated the Q&A, so let's get into it. Who is this borrower?
It's a long-standing client. The total relationship is just under $30 million, and about $20.4 million of that got downgraded in the quarter.
And the asset, the collateral.
It's primarily land parcels for multifamily housing development, located in that corridor between Milwaukee and Chicago.
Prime territory, you would think.
Theoretically. But it's a classic developer trap. They bought the land but couldn't get to the construction phase. And all the while, carrying costs, taxes, interest, or just eating up cash.
The runaway runs out.
Exactly. It's a liquidity crunch.
But here's the part I found a little risky. They downgraded the loan, they stopped counting the interest, but they didn't set aside any money for a loss, no specific reserve or charge off.
I know, it sounds wild. You downgraded $20 million loan and put $0 in the rainy day jar for it. But management was very firm on this. It all comes down to the loan-to-value ratio, the LTV.
Okay, explain how that saves them here.
They said the LTV is only 72% across 7 different properties that are cross-collateralized.
Meaning the loan is only 72% of what the land is actually worth.
Precisely. So their logic is, even if this guy never pays us another dime, if we have to foreclose and sell the dirt, there's enough equity buffer there to get our principal back in full.
And they have fresh appraisals to back this up.
Yep, some from the very end of 2025. They're confident in the valuation. So they believe they have, I think they said, 2 or more ways out.
Plan A, the borrower figures it out. Plan B, sell the dirt.
Exactly. And they were blunt about Plan B. Foreclosure is a very straightforward option for them. It's slow, sure, but they don't believe they'll lose principal.
Okay, but even if they don't lose principal, the earnings hit was real. It shaved 10 basis points off the margin in Q4. It
did. And management's argument is, if you adjust for this one-off event, if you just pretend the dirt debacle didn't happen, their NIM would have been 3.63%, right in their sweet spot.
So the pitch is, ignore the smoke from this one fire. The rest of the house is in great shape.
That's the pitch. And honestly, if you look at the rest of the business, it's a pretty strong argument.
Let's pivot to that. The aspirin for this headache. The growth engines. Because the fee income story is incredibly strong.
This is where FBIZ really stands out from a standard community bank. It starts with private wealth. Their private wealth business is becoming a powerhouse. Fee income hit a record $3.8 million, up 11% year over year.
The CEO called it annuity-like income, which I liked.
It's the holy grail for a bank. Interest income is volatile, it moves with the Fed, but wealth management fees, those are sticky. It just keeps rolling in, whether rates are 2% or 5%. It stabilizes the whole ship.
Then you have the other side, the specialty finance piece. Asset-based lending, ABL, and SBA lending.
Right. And ABL is a bit different from a standard business loan. It's not based on cash flow. It's based on assets, inventory, receivables, machinery.
Sounds like more work.
It is more work. It's more technical, harder to underwrite. But because it's harder, the yields are higher. You can charge more. And service charges there were up nearly 20%.
And that's tied to the new leadership they brought in a while back.
Yeah, in Kansas City and Northeast Wisconsin. It looks like those seeds are finally turning into trees. The pipelines are reportedly very full.
Okay, speaking of things that are a bit complicated, we have to talk about the accounting noise. There was a weird shift in other income. Can you decode that?
Sure, let's get into the weeds for a second. This is about their limited partnership investments. Historically, they booked the revenue in one line, expenses in another. Now they're just netting them together.
So it's just moving buckets around, no real change to the bottom line.
Mostly. But the real story here is what they call the J-curve.
The J-curve.
Right. When a bank invests in these funds, you pay fees up front. That's the bottom of the J. You lose money at first. The gains come years later. That's the upward stick of the J.
And where are they on the J right now?
The CFO said they're at the bottom, eating those costs. But they expect to start climbing the J-curve in 2026. So those investments should stop being a drag and start adding to the bottom line.
Which brings us to efficiency. They talk a lot about operating leverage. What's the simple definition?
It's just, is your revenue growing faster than your expenses? And for FBIZ, they achieved positive operating leverage for the 4th consecutive year.
Revenue up 10%, expenses up only 6.5%.
That is hard to do in this environment. Now, they did warn that compensation costs are rising in 2026.
People are expensive.
They are, but they still expect revenue to outpace expenses. They're trying to grow their way to efficiency and not cut their way to prosperity. It's a different mindset.
Okay, let's shift to loan growth. On the surface, Q4 looked a little sluggish, up about 5% annualized.
Yeah, half their target. But you have to look at what they call the payoff problem. In 2025, clients paid off loans about $70 million more than usual.
So they're pouring water in the bucket, but there's a big hole in the bottom.
Perfect analogy. If you normalize for those payoffs, their growth rate would have been 11%. So the origination engine is fine. They just had a headwind.
And looking ahead, they mentioned the balloon effect. What's that about?
This is a key macro insight. Think back to 2020, 2021. Rates were basically zero. A lot of banks wrote 5-year commercial real estate loans.
And 2021 plus 5 years is 2026.
Bingo. Those loans are hitting maturity right now. Those borrowers need to refinance, and the banks that wrote those loans might not want them anymore.
So FBIZ sees this as a hunting ground.
It's a massive opportunity to steal market share from struggling competitors.
They also dropped a little nugget about tax policy changes in 2026 being a potential tailwind.
They did,
Yeah.
specifically for their C&I and equipment finance clients. I mean, if the government lets businesses write off equipment faster.
Businesses buy more equipment.
Yeah.
And they need loans to do it.
Drives demand right into their wheelhouse.
And on interest rates, they're not betting the farm on cuts.
No, which is good. They call their balance sheet interest rate neutral. They don't need cuts to hit their numbers. If rates drop, it's a bonus. They're not gambling.
Now, I want to talk about strategy. An analyst asked about M&A, and CEO Corey Chambas gave one of the most blunt answers I've ever heard.
It was so refreshing. The question was, are you looking to buy other banks? And Chambas just said, one-word answer, no.
Just no. And he went on to explain why, and it was basically a takedown of the traditional banking model.
He said, we hate branch networks. He thinks they're dead weight. And for their clients, business clients, he's probably right.
They don't walk into a lobby. They use remote capture wires, couriers.
So why pay to heat and staff 50 retail branches your clients never use? Buying another bank means buying their branches, which they just have to close. It's dilutive.
So they're playing the anti-M&A game. They are a compounder, not a roll-up.
That's the philosophy.
Yeah.
And their target is to get specialty finance, SBA, ABL, all that stuff, up to 25 to 30% of their loan book.
It's at 23% now.
That diversification is so critical. It protects them from being at the mercy of one local real estate market.
And the proof is in the pudding. They hit a return on average tangible common equity ROATCE of over 15%.
For a bank this size, 15% ROATCE is top of the class. It proves the branchless model works.
So to summarize, you have a bank outperforming its own goals,
Right.
hiking the dividend 17%, refusing to do dilutive M&A, generating a 15% return on equity.
But they're sitting on a pile of distressed land in Wisconsin that is currently a potato stuck in the Ferrari's tailpipe.
Which leads us perfectly into our This Is Not Financial Advice segment.
Yeah.
Standard disclaimer.
Yeah.
Do your own due diligence. This is for entertainment, but what's the trade?
All right, let's get creative. I'm calling this the Midwest Land Baron Branchless Short Pair Trade.
I love it. Break it down.
Okay, here's the setup. You go long FBIZ. You're buying the distressed asset pop. The market is over-penalizing them for this one headache. Management says the land is worth more than the loan. If they resolve that in late 2026, the non-accrual reverses, you get a sudden injection of interest income. It's a hidden catalyst.
So you're betting on the dirt.
You're betting on the dirt and the organic compounding engine. But here's the other side of the trade, the hedge. You short a basket of branch-heavy regional banks in the same geography.
Ooh, interesting. So you're betting against the traditional model.
Exactly. You're shorting brick-and-mortar inefficiency. It's an arbitrage on the business model. Long, dirty fingernails, banking specialty finance, land deals, and short retail storefront banking.
It's an efficiency play. You're betting their 15% ROE is sustainable, and the resolution of the land deal is the kicker.
That's it. If Chambas is right about that land value, that reversal is essentially free money for shareholders that the market isn't pricing in today.
Okay, devil's advocate, what kills the trade?
Two things. One, the developer declares bankruptcy, and this gets tied up in court for years. Or two, the appraisals are just flat out wrong and the land value tanks.
And as we know, dirt is not a liquid asset.
It is not. You can't day trade a muddy field.
So what's the one metric to watch to see if this thesis is on track?
Keep an eye on that specialty finance percentage. If it ticks up from 23 toward 25% next quarter, the thesis is intact. If it stalls out, or we hear more bad news on that land, maybe run for the hills.
That's the signal. All right, that's a wrap on First Business Financial Services, a fascinating look at how one borrower can obscure a record-breaking year.
It's going to be a very interesting 2026 for them to watch.
We'll be watching. We will catch you on the next tick. Talk soon.